Okay, good morning, everyone, and happy Friday, and welcome back to our Friday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and let's go ahead and take a look at where the markets are currently trading this morning. Now, before I get started, what a quick disclaimer, what we're going to discuss here today is purely for demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So let's go ahead and get started, and let's talk about the overall market. The S&P over this past week has broken out to new relative highs after spending the most of March and April range bound between roughly 275 and 295. Last week was really when we started to push above this range, and this week we started to get the continuation of that push higher. Now, for the past few weeks, we've discussed how every single time this market has continued to push sideways and slightly higher, momentum has not confirmed those moves higher, but momentum has started to push a little higher here. So we do have further support that this rally is here to potentially stay. Now, 302 is a level that really goes back to all the way to April of 2019. And these were levels that we have for a long time said was a major resistance level until it broke out above here in late October, early November 2019. So we're back to revisit those levels, and it looks like we're about to open up just around those levels again. So if we do get a breakout above this level as any type of significant breakout, which we might see a bit of a pullback here first to the 20-day moving average before you get the momentum to continue moving higher, that's yet to be seen. But 302 is a major level for us to watch here on SPY. The technology index, this is the QQQ or the NASDAQ 100 index, has obviously been significantly stronger than the S&P 500, but over the last couple of weeks, as markets continue to push higher, this index continues to move sideways. So we're seeing a lot of sector rotation across the board, where technology and healthcare led for quite some time, then technology took over. Now, everything from energy and financials looked really strong earlier this week, and now utilities and staples are joining in this rally. So we're seeing very broad participation in these rallies, and there's just a lot of sector rotation going on from day to day. So you have to be really nimble trading these markets, because what's leading the markets this week may not be leading the markets next week. And we're really seeing a lot of shifts in terms of the sector rotation over the last few weeks. This week being predominantly utilities, staples, real estate are the ones that are very strong, versus the technology, healthcare have been relatively weak this week. Small caps also fizzling out a little. Last week, small caps was the strongest out of the groups, but small caps, as you can see yesterday, despite us moving higher, is actually down significantly quite a bit this week. But overall, small caps have broken out above this 136 level. This is IWM, the Russell 2000 ETF. Broken out, is coming back to retest that support level. So there is some potential support here for a potential move higher. At least a risk to reward on a long here makes a lot of sense, because you're very close to that 136 level. You have quite a bit of room to the upside, at least around 152 or so to the upside. And if it pulls back to around 132 or so, that would be a good stop loss level. So you have a really good 3-to-1 risk reward level here on a long here in small caps. So broadly, we're seeing a lot of support for this market to continue moving higher. We have broad participation across the sectors, small caps joining in the rally. This is all, again, supportive of a move higher. Now, there are a few things that have that are worthwhile looking at, meaning this isn't just a straight shot, clear cut, that we're now in more of a bull market here, because above 302 certainly puts us in from an absolute value perspective, back in a bull market. But over the last few weeks, as markets continue to move higher, the VIX has really kind of bottomed out here around this $28 level, and it's sitting between 26 and 30 or so. And right now we're trying to see as far as which way it'll break lower. Obviously, if the markets continue to move higher, likely what we're going to see is VIX break lower. If we break lower, then we certainly revisit probably back to 23 or so to the downside. That's our base case at the moment. But with this basing formation here, it's always possible that you get a breakout higher. But so far, every single time the VIX has touched the 20-day moving average, it has sold off. It is near that again, and the question is whether or not it's going to sell off. Now, if we have a bullish view, that's going to be our base case that VIX is going to touch that 20-day moving average and sell off here again. So that's where the major indices are and what we're currently looking at in terms of macro positioning, thinking about broad picture. Now let's take a look at some of the other research that we want to take a look at. So first of all, we've sort of started to get this break above this major 300, 302 level. I do expect that 302 will be a tough level to get above, just like how 285 was a major level that we traded around that level for quite some time. I wouldn't be surprised if we saw the same thing at 302, that every time we got up there, it bounces off a little bit before it cracks above it. So we could be at this level here for the next few days, next few weeks before it breaks out. It's hard to say at the moment, but it's really important level to take a look at in terms of whether or not we can break above it. As I said, VIX has stabilized and VIX oil has also stabilized around 33. This is all supportive of this broader market rally that we're currently seeing, because we are seeing participation across a much larger group. The number of stocks that are above the 20-day moving average is 82% of stocks are above its 20-day moving average. 88% of stocks are above its 50-day moving average, but only 33% of stocks are above the 200-day moving average. But that number is improving quite a bit. It was in the low 20s even just a couple of weeks ago. So we are starting to see improvements across the board as markets are trading somewhat sideways, I would say. If you look at the S&P, if you look at the NASDAQ, they haven't really progressed much in the last few weeks from a percentage perspective, but we are seeing broader market participation, which is good. Now, liquidity did evaporate quite a bit over the last few days. Only 107 very liquid optionable symbols. I think when I did this on Tuesday, it was in the 200s, and the week before that was a little over 300. So we're seeing some decrease in terms of liquidity in the markets. That is a small concern to us, but again, at the moment, this could reverse trend very quickly and get back to 200 liquid names. So we'll see that and monitor that as we open here today. So one of the things I want to show you is some of the reopening trends, because we are starting to see some reversals in economic activity. We are certainly starting to see some additional data to give us a sense for which industries are seeing bounce backs that are relatively strong, which ones are still relatively weak, and that helps provide our investment thesis going forward for the next few weeks, next few months, especially now that earnings season is over. Now we're looking forward towards the next earnings season. A lot of people are looking at economic numbers to get a sense for that. There are some good numbers that came out this week, so I want to review some of those things here with you. So first and foremost, the question is really whether or not we are at a turning point or not. Now, if we look at most of the high frequency economic data, most of them have at this point bottomed out and have started to reverse higher. Now, some of them that come out once a month, like GDP, or once a quarter, have not started to reverse yet, but we expect those to reverse in May. So first of all, unemployment peaked at about 25 million unemployed, but as you can see that we're starting to see a decrease here in continued claims. This is telling us that there are some companies that are starting to rehire workers that were laid off. Initial claims also peaked quite a bit earlier here back in April and has continued to decline, meaning new people seeking unemployment is declining, and the total number of people that are unemployed are declining as well. The question, though, is how much is this going to start moving lower and at what speed? So I would say that every single time you get a move lower, that's going to be a general net positive for the market. But any type of revision or any type of stabilization in this number before it starts to move lower, that's going to be the negative news, if you will, because never in the history of our country have we seen 22 million unemployed. That's just a number we've never been at before. So we have really no history to utilize for a template here. Durable goods, also, this was one of the better numbers that came out this week. Durable goods came out, I think, a little under 8% below. The number was negative 8%, but we were expecting negative 15%, which is one of the strongest, I would say, indicators of our economy in terms of durable goods. Durable goods referring to things like car purchases, washing machines, these types of purchases, large purchases that generally drive a large factor of our quote unquote consumer economy. So durable goods coming in significantly stronger than expected is supportive again of a recovery, and the speed at which we're going to recover and the magnitude of how big the impact was. Durable goods, as you can see, was one of the biggest impacts during the financial crisis. So we did have a pretty big dip, but we do expect this dip to recover significantly faster than during the financial crisis. So more of a bit of a V-shaped recovery expected here. So those are some of the good news coming out, and that's driving some of the optimism we've seen in the markets. I will say this week, less news on the COVID-19 vaccine trend and treatment trends, if you will, much more so on the economic activity front this particular week. The credit card data, this is something we've also been taking a look at. This is Bank of America's credit card and debit card data over the last few weeks. Not a huge number of significant changes, but one of the things that's interesting here is that entertainment, despite many states having opened up, still remains very, very low. Airline also still basically at 100% lower than last year. Lodging is starting to see a little bit of a trend here, and we have some names to take a look at here today as far as lodging, to see if we're starting to see a little bit of an uptick here in some of the hotel names. Restaurants, also not much uptick here in restaurants, but I do have some data to suggest that there are certain restaurants that are actually seeing almost back to normal spending versus others, which is predominantly in the fast food space, which I don't think is necessarily surprising. Furniture still continues to be relatively strong. So if you think about stocks like Wayfair, if you things like stocks like Home Depot, home improvement also still remains very strong here, actually still continuing to accelerate. So Lowe's, Home Depot, those are going to be net beneficiaries. Total online retail continues to grow. And this really comes from the fact that brick and mortar stores have seen significant declines in terms of spending, and that spending is now shifting to online. There is some I would say start of what looks like that trend starting to reverse, but it's very little in terms of the reversal. So it's not quite yet, I think, ready to call that, a start of reversal just yet. It's only been 1 week and it's a very small decline. So it could be just some noise. It's yet to see as far as whether this is going to be a trend or not. But overall spend, as you can see, hasn't really, improved much over this past week or so. We're not seeing some significant increase in spending just yet. So, that's the data that we're currently looking at in terms of how consumers are spending at the moment. So some of the names I wanted to take a look at reflect this kind of potential turning point that we are at with respect to the economy, with respect to opening up. All 50 states at this point have some plan as far as reopening. There are only 2 states at the moment where COVID-19 cases are still continuing to get worse. We have a handful of states that are kind of stable, if you will, and the rest of them are improving, which is a good sign. And as a result of that, you have some of these stocks that weren't particularly great stocks prior to COVID-19 that had benefited from it, such as Campbell's Soup. And there's a lot of them in terms of Kellogg's, General Mills, any of these kind of food staple stocks that really benefited during the stocking up prior to COVID-19. Some of these names are starting to weaken a little. So one of the names, particularly Campbell's Soup, which wasn't particularly strong going into COVID-19, as we come out of it, as people stocked up on canned goods, but are now perhaps getting back out there and eating out, these types of stocks may see their rallies come to an end. So these types of names, my preference is still to sell premium, because I'm not necessarily expecting that we're going to have a catalyst in the next few weeks or necessarily in the next few months where you're going to see a sharp decline in these types of stocks. I think stocks like Campbell's Soup, General Mills, Kellogg's, they're more likely going to grind their way lower, perhaps as consumers spend less and less time at home. So as Campbell's Soup is kind of right around this major $50 resistance level, which was prior to COVID-19 and which coincides with the 20-day moving average, my preference for a type of play like this, where you're basically saying that these types of COVID-19 stock-up stocks their rallies are coming to an end, is selling call spreads instead. So an example of that, for example, for Campbell's Soup, would be something along the lines of selling perhaps a call credit spread, just to give you guys a quick sense for what I'm referring to. So something like selling maybe a $50, 52.5 call spread. As you can see, this is a $2.50 wide credit spread, collecting 90 cents or $90 while risking $1.60, a little less than 1.5 to 1 risk reward ratio. These are the types of risk reward ratios that you're trying to seek when you're selling a call credit spread. And basically this will profit as long as Campbell Soup doesn't go above $50.90, which is well above that, that major resistance level prior to COVID-19, as well as above that 20-day moving average. So that's an example of a type of trade that we're currently watching for as things start to turn around, as we kind of meet this kind of pivot point, if you will, as things start to get back to, I wouldn't say normal, but try to get back to where we were prior. Facebook, here's another technology stock that we've been looking at. Now, Facebook broke out very quickly above that all-time high. I will say, a little surprising to see Facebook at all-time. Sorry about that. Can everyone hear me? Just want to make sure everyone can hear me. If you can, please type yes into the chat window. Okay, sorry about that. So Facebook, what we were looking at is a breakout above that 220 level, which we did, and it went very quickly. It was very difficult to chase, but we have an opportunity where it now is now revisited back to that 220 level. So from a risk to reward perspective, this is a great opportunity from a risk to reward perspective to look at a long position here, because if it fails below it, you're not risking very much. And I do think you have quite a bit of room to the upside if it does continue to move higher. Now, this type of play, this is really where, because volatility has come down significantly, it's still not cheap by any means, but this is the type of play where I would prefer to then use a call debit spread, where I'd be buying options because I'm trying to risk the least amount of capital possible. I would look out to July and buy something like a 225, 250 call spread. This would cost me about $8.75. And if you think about $8.75 on a $225 stock, is risking only 3.8% of the underlying stock price to bet that Facebook could potentially reach up to 250 by July expiration. So those are the types of risk to reward ratios that I'm seeking when I'm looking for these types of bullish opportunities. I'm only risking 3%. If things really turn around and, I don't know, let's say the president starts going after all of these social media platforms and we see a decline like we saw in Twitter, this is really the type of play where I want to make sure that I'm limited in terms of risk here. At only about 3.8%, I'm very comfortable taking on those types of risks. Same type of play here on Twitter. Twitter, obviously a little bit more volatile because of what's currently going on with them censoring or I would say censoring some of the tweets by President Trump. But I do think from a chart perspective, very similar setup here. You have this triangle that it traded within, finally broke out, is now retesting that support. And I think you have a potential move higher. There are some additional, I would say, risks with this stock compared to Facebook, but very similar trading setup in this particular stock. Hotels. So one of the things is that in the credit card data we saw, there was small uptick in terms of hotels. They were only down about 70% compared to last year in terms of spend. Now, we did get news back here on earnings that Marriott was starting to see an increase in terms of bookings. So the fact that the stock was down roughly 6% yesterday, I think is an opportunity to potentially play for that long side, especially it gets close to that 20-day moving average. I think you have a good risk to reward for an entry here for the long side. Again, for a name like this, my preference is to risk the least amount of capital possible, because with any of these travel stocks, you know, all it takes is another second wave or some kind of ban from other countries in terms of letting people travel, and also corporate travel has not picked up. That's one of the things about travel data, is that most of the uptick we've seen in travel has predominantly, almost all have been in leisure travel. So corporate travel not coming back at all. And that's predominantly where airlines, hotels make most of their money, is on corporate travelers. So be careful about these names. I think it's very important that if you're trying to play for a bounce in these types of stocks, whether it's hotels, airlines, I will say cruise lines is all leisure. So you might actually see cruise lines will rally perhaps a little stronger than hotels and airlines. So if we look at something like here, this is quite expensive. This is $6.85 on a $91 stock. So we're risking here 7.5%, unlike some of the other, like Facebook, where we saw we're only risking under 4%. So more risk in these types of names, obviously also potentially more reward in a name like Marriott than Facebook, in my opinion, especially if you have some strong travel data news coming out, or if more states reopen up. I want to take a look at Zoom, because Zoom reports earnings next week. And Zoom is one of the few stocks that are still left on our calendar that is, I would say, liquid. Over the next few weeks, we have almost none coming up. Basically, 96% of the S&P 500 has finished reporting. So I'm really not expecting much here, but Zoom, I'm looking at this particular chart. This was a difficult one to make a decision on, because every single time the stock continued to move higher, momentum continued to move lower. But on the same token, you have every subsequent higher high, higher lows, and momentum did confirm each higher low. So at this point, the fact that it's managed to get back above its 20-day moving average is certainly positive, and you could play for an upside here going into earnings. I haven't taken a look at the options here on Zoom yet. I can just take a look at it real quick. My first gut feeling was to sell put credit spreads, like we have been over the last few months in terms of earnings plays, something like a 162, 150 credit spread. This is a $12.50 wide credit spread. I'm collecting $5.40, which is, let's see, $5.40 divided by 12.5 is 43% of the width. So I am collecting a fair amount of premium here. And as long as Zoom kind of stays where it is, but it doesn't move much higher, those are the types of plays that I'd prefer to be utilizing, is selling a premium. And I'm not risking substantially more than the credit that I'm collecting, which is always a concern when you're selling a credit spread going into earnings, is you get a really bad earnings report and the stock plummets and you're risking twice as the income that you received. Here, because I'm collecting 43% of the width, I'm only risking about 56% of the width. So a relatively small percentage of risk here. And as long as Zoom stays where it is, and my break even here is 157, which gives me about a 6.5, almost a $7 buffer here on this particular name. So even if Zoom moves a little bit lower, this is the type of strategy that can still be profitable even if Zoom moves a little bit lower. But I quite like this particular stock, because I actually think that work from home is going to last significantly longer than many of us may have originally anticipated, or even anticipate at the moment. I think, especially when we look at corporate travel data that has not picked up at all, this is continued supportive of Zoom's I would say play for work from home. And I think work from home plays are going to work for significantly longer perhaps than we may anticipate. So Zoom, certainly one that I'm paying attention to for earnings next week. Not a lot of earnings left here. Fast food, this is what I wanted to take a look at, because credit card data that we have seen in terms of restaurant spend has also bifurcated the same way we've seen bifurcation in the retail space. So what we have seen is that fast food, specifically names like McDonald's, Burger King, Wendy's, these types of plays in terms of if you look at credit card data, has almost gotten back to normal. They're only about 10% below normal, versus fine dining is still about 60 to 70% below normal. So the fact that you have this chart, which looks, from my perspective, fairly constructive for a potential breakout here. You have a major support level that goes all the way back to November, tested it as, broke below it here during the sell-off, tested as resistance, and now it looks like it's starting to potentially break out here. This hasn't broken out yet. Perhaps we might see a breakout today. That's why I wanted to put this on your radar. But you do have a very nice, I would say, almost like a triangle here that can potentially break out higher back into that 200, 215 level. So from a risk to reward perspective, I also like this. Again, for these types of plays, I would use a strategy to limit your risk here, because right now, as far as we are concerned, the base case is market moves higher, but there's always the chance that these stocks, there's some kind of catalyst that causes the markets to move significantly lower. Now, the only thing about McDonald's that I didn't love is the fact that the July options, there are no strikes between 200 and 210. I would love to have sold the 205 strikes instead, but there just simply aren't 205 strikes. I think the 200s are a little too low, and I think the 210s are a little too high. So maybe they'll list some more strikes here for the July expiration. And you'd have to go all the way out to August to, August is a little bit more expensive, but maybe that might be worth looking at. And I would, for a breakout play, I'd probably buy something slightly out of the money and risk less money here. So $7.51 on a $187 stock is risking, again, only 4% of the underlying stock to try to play for a breakout here in a stock like McDonald's. So that's how I think I would be looking at playing McDonald's here. For a potential breakout based on the data that we've seen with respect to restaurant data, and how fast food specifically has seen significantly better spend. Even fast casual is below fast food. So I'm actually, if you look at a stock like Chipotle that has made all-time highs versus McDonald's that's still barely near all-time highs, this is a segment of the market that has not seen the same uptick in spending as McDonald's. So that's why I'm also quite bullish here on McDonald's. Also, perhaps slightly bearish on Chipotle, and I think it's going to pull back maybe to that 940 level before it continues to move higher. But Domino's Pizza has been consolidating for quite some time between this 380, but it's also has this kind of triangle wedge that's forming here. It's yet to see if we start to see a breakdown. I certainly think that if restaurants start opening up, these types of stocks will likely come under pressure, similar to the Campbell Soup, General Mills types of plays. That's really how we're looking at these types of plays here. So that's just a quick overview of what we're discussing and looking at here this morning. This gives you hopefully a sense for how we're looking at the markets, what opportunities we're currently keeping an eye out for and potentially trading today. So I hope that you guys find this useful in helping you set up your trading day. I do have a couple of minutes, and I see a couple of questions here regarding, Jay's asking, regarding your Zoom trade from StockTwits. Is this for another trade? This is for a completely another trade. This is for an earnings play. Joel is saying, Tony, the McDonald's options play score is only 85. Is it worth it? So if you look at the midpoint, which is usually where I would price out all these things at, it's at 684, it's at 95. I would say 95 is okay for me. I'd obviously like to see a little better than that, but I would certainly consider playing this at 94, 95, especially because I'm only risking 4% of the underlying stock. For me, that's more important. On a stock like McDonald's that can move quite a bit, I think that if you do get a breakout above that 190 level, you could get a move up to at least 205 fairly quickly. I like those types of odds if I can only risk 4% of the underlying stock. So I hope that you guys find this useful. I really appreciate all of you taking the time out here this morning to participate. I'm sorry I didn't get a chance to answer all of your questions here, but it looks like I was able to get through most of them. So thank you so much. I hope you guys have a great weekend. Happy Friday, happy trading, and I'll see you guys next week.